Valuation cap is likely the most negotiated term for funding transactions. This video describes where the valuation cap is used, what it does, and other places it is found with respect to early stage funding. Valuation cap is the very first term that is negotiated in convertible notes or safes. These two types of convertible investment vehicles are useful for early stage rounds because of the minimal disclosure obligations and financial history required. The investor is securing their place for the stock that is sold in the next qualified financing. Investors like these types of convertible securities when companies have growth potential. Valuation cap sets the maximum price that convertible equity will convert, entitling investors to equity priced at the lower of the valuation cap or pre-money valuation in the subsequent financing. It secures the investor's price in the event the company has significant growth before the next financing occurs. If the valuation cap is higher than the qualified financing, your investors don't receive any benefit. Valuation cap determines a company's price per share. The formula is valuation cap divided by pre-money capitalization. Let's break that down. Say you sold a round of convertible notes in the principal amount of $100,000, 8% interest, and a valuation cap of $5 million, which is used to determine the price per share of conversion into the next qualified financing of at least $1 million. Remember the formula: valuation cap, $5 million, divided by pre-money capitalization, $5 million, equals 1, or $1 price per share. This spreadsheet describes what happens when the equity financing actually occurs. Here, the company sells $2 million of equity with a pre-money valuation of $8 million. Remember, we calculated that convertible notes will convert at $1 per share because the valuation cap on the notes was $5 million. With principal and interest, the notes convert to 104,000 shares of Series C. Remember the price per share calculation? The new investor's price per share is higher because their pre-money valuation is $8 million, divided by the pre-money capitalization of $5 million to arrive at $1.60 per share. This demonstrates a great savings to your early investors. Determining your valuation cap involves careful planning, analyzing your industry, your company's management, and your company's future earning potential should be taken into consideration when evaluating valuation cap. As always, consult with your CPA or other financial professional before you start negotiating valuation cap with an investor. You want to prevent undervaluing your company.